I'm Leslie Appleton-Young, Chief Economist for FMLS. The key word for the economy and the housing market is uncertainty. The drumbeat of recession is growing louder, and the prospect for higher inflation looms. We've seen plenty of soft data, what people think will happen. Surveys on consumer confidence, business sentiment, and market conditions have all suggested that economic trouble is brewing. For example, the University of Michigan's Consumer Sentiment Survey has fallen sharply from 74 in January to 52.2 in April. This is the second lowest rating on record as consumers express concerns over tariff-induced inflation, job stability, and recession fears. In fact, year-ahead inflation expectations have surged to 6.5%, the highest since 1981, and up sharply from 5% just in March. Closer to home, a recent survey by Clover found that 1 in 4 home buyers and 1 in 8 home sellers were now delaying these moves. And the future is not just theoretical. In the stock market, somewhere between $4 and $9 trillion in wealth has disappeared since January. But what about the hard numbers, the quantitative data that tells us what is actually happening? Things like GDP, employment, housing starts, and home sales. First, straddling the line between soft and hard data is the GDP Now model from the Atlanta Fed. Economists there take hard data as it becomes available and feed it immediately into a model that predicts GDP for the current quarter. Indicators of production, consumption, and trade, among others, are incorporated into the model, and they are updated and revised as data becomes available. It's not an official forecast, but a running estimate of real GDP growth. Most recently, they are projecting a 2.5% decline for the first quarter. In fact, from boardroom to Wall Street, the probability that we will see 2 quarters of negative growth, the minimum needed to call a recession, is growing. Last week, the National Association of Realtors reported home sales for March, and the numbers were concerning. Coming in at 4.02 million sales at an annual pace, this was the lowest total for a March in over 20 years. After registering a 2% year-over-year gain in January, March sales were down 2.4% compared to last year, the second month in a row of a year-over-year decline. But what was even more startling was the 5.9% month-to-month drop in sales from February to March. This is the first decline in at least a decade. This was experienced in every region of the country, including the South, where existing home sales contracted 5.7% from February to March and were down 4.2% from 1 year before. NAR and Census Bureau data consistently show a 15 to 20% increase in home sales from February to March in most years, outside extraordinary conditions like the pandemic. This is because the spring home buying season is typically characterized by planning ahead for fall schooling, warmer weather, tax refunds, and this year, an eagerness to take advantage of the increase in listings. So what happened? While March closings went under contract in January and February, well before the April 2nd tariff announcement, it's possible the rising tide of uncertainty before then played a role in consumer behavior. Listing cancellations, as we have noted before, have been on the rise. But mortgage rates are also at play here. According to NAR's chief economist, Lawrence Yun, home buying and selling remained sluggish in March due to the affordability challenges associated with high mortgage rates. Freddie Mac reported on April 24th that mortgage rates were essentially stable at 6.81% on the heels of a 21 basis point increase the week before. In fact, rates have been elevated for months and on the upswing for much of April, and mortgage applications have responded to higher rates with sharp weekly declines. The bottom line for the future is that markets hate uncertainty, noted former Fed economist Claudia Sahm. Will rates fall because we are heading into a severe recession? Will they rise due to larger budget deficits, more uncertainty, or higher inflation expectations? Anything is possible, and that is part of the problem. Looking ahead, we are likely in for more volatility in rates as the markets react to trade and tax policy changes. Take a look at market intel on the FMLS website to access the most current market statistics. They are updated weekly. So if you're interested in resources relative to our market dynamics and want to dive into local markets, we've got you covered. For FMLS Market Intel, this is Leslie Appleton Young. See you next time.